Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, March the 19th, 2026. Apologies, there was no video yesterday morning, but the internet was down, excuse me, for a few hours. There was a big storm which knocked out a bit of power. Okay, let's just go through a bunch of markets. Obviously, we had the Fed yesterday. The market interpreted that as being more on the hawkish side. Obviously, they didn't sort of hike or cut or do anything. But essentially, Powell, just taking some notes during the meeting, Powell said that they need to make progress on inflation. They need to see goods inflation coming down. Uh, and that they believe that energy shocks, they needed a bit more information. But essentially, was saying that they needed to see more progress on inflation. And in terms of the dot plot, he said that several people went from 2 to 1 cut. So even though what you can see here on the dot plot is that they didn't change it. So initially the market looked at that and went, oh, it was 3.4 in December and then came to 3.4 for the Fed funds median for 2026. But basically, so the initial reaction was a little bit on the dovish side, saying, hey, they're still planning to cut at least once this year. But what you can actually see here is that the GDP projections were revised upwards a little bit. Unemployment was not revised upwards, so they still see labor market as being in equilibrium. But on the core PCE inflation, they actually revised that up a little bit. So essentially, what the summary of economic projections was saying were that the economy still remains strong, unemployment remains at a reasonable level, and inflation is ticking upwards and is still a bit of a problem. And Powell was at pains during the press conference to really emphasize the fact that there were still problems with goods inflation was still relatively high, and that what did he call it? Non-core inflation, non-housing core inflation still needed to come down. And he said, a quote, no progress on inflation, no rate cut. No progress on inflation, no rate cut. So, and essentially he discounted, poo-pooed a little bit this sort of the dot plot, saying, hey, don't worry about that anyway in terms of that. And he took the pains to actually sort of emphasize the fact that several voters, maybe even he, went from 2 cuts this year to 1 cut. So even though the median remained at 3.4, if you actually look at the actual dot plot itself in a bit more detail, there was a sort of a slightly hawkish shift. All that to say that the market took away from that a little bit of hawkishness, and we saw the front end of the curve sell off fairly aggressively during the press conference. We also saw the dollar strengthen. We saw the bonds in general sell off, and of course, we saw equities sell off and gold selling off. So some people saying, why is gold selling off, in a climate of sort of geopolitical risk? And it's very simple. Is that, the real yields, yields are going much higher. The nominal yields certainly are going a lot higher, and keep in mind, of course, that gold does not bear interest or provide income in any shape or form. And secondly, of course, a much, much stronger US dollar is putting downward pressure on gold. And I think also we had a big positioning flush out, and that long-term holders are probably still holding, but the sort of the tourists, the macro tourists or the gold tourists are probably leaving the party, so to speak, as they are in silver. Anyway, so what I want to have a quick look at here is just to go through various markets, because we have all kinds of central bank meetings and everything, so it might just be easier to go through. So quickly having a look at volatility, looking at the VIX. It remains elevated. It's off its highest levels, but the reality is that we're still in the mid-20s, so still very elevated on the VIX. If we look at oil, that's come down a little bit, but it's still at extremely elevated levels. Just having a quick look at the MOVE index for bonds, that's come off its highest levels, but is still elevated. So I guess what we can say for volatility is that although not at the highest levels, we're still at elevated levels. And that is going to be, that's a problem, because it means that, VAR sort of value at risk metrics are going to be reduced. It's going to cause mechanical reduction in sizing. It also means that specific vol targeting funds will reducing their size, as will sort of CTA funds. So a lot of the big sort of more sort of quantitative funds, just with this elevated volatility, it's going to be difficult for them to make significant positions. Okay, excuse me, just having a bit of tea here. Still a bit sick. Okay, so if you're looking at equities, Basically, just looking at the futures, I mean, it's very, very weak price action, as I've been saying here. All for the last few days, all rallies are being sort of whacked. And keep in mind that when we have the elevated volatility, just because something bounces, remember, volatility can go in both ways. So a little bounce of, sort of 50 points or 75 points on the S&P 500 futures doesn't necessarily mean sort of a rally. And what we can see here is that in terms of all the EMAs, the exponential moving averages, the 20 now has crossed below the 50 and the 100. And essentially we've breached the 200-day moving average on the EMAs and on the SMA as well. So if you actually look at that, you can see that we haven't really done that with any sort of regularity, except for this period in the Liberation Day when Trump introduced his tariffs, and we swiftly sort of punched above that. So, this is now looking a little bit fragile. And you can see here that the key level on the downside, of course, is something like about 66.30 on the continuous contract here. And you can see that we had a big down sell-off yesterday. So the market is probably just saying, hey, we have elevated interest rates. We have a Fed which may not be cutting at all, maybe just one interest rate cut over the next sort of 6 or 12 months or so. The other thing as well, which got the market's attention yesterday, is that, excuse me, Powell did provide a little bit more clarity on his future career path. And he basically said that until this criminal probe into the Fed and he personally is sort of done and completely finished, he will stay on as a governor, even, and he will also, until and unless Wash is sort of confirmed, he will also stay on pro tem, to use the Latin expression, so sort of temporarily. And so there's raises the specter now that maybe Walsh will come in May or June, but Powell may hang around for another, who knows, 3, 6, 12 months or something like that. And that's just going to make the reaction function of the Fed a little bit harder to interpret. So that's, and also at the margin, could that be slightly more sort of a hawkish? You have an ex sort of chair sort of hanging out in the governor's seat who is, definitely not going to just sort of cut for no reason. So, that was possibly a little bit hawkish as well, that sort of information from Powell. Anyway, the point being is that both the ES here and also looking over at NASDAQ, trading very heavily as well below the 200-day moving average. Key levels on NASDAQ, obviously about 24,400, 24,500. And if we look at just some of the underlying sort of metrics of the equity market, we can see that the number of stocks in the ES which are trading above their 50-day average, you can see how that's kind of collapsed since the wars started. And we're now only at about 28% of companies are trading above the 50-day average. So, a few companies are doing well, but overall the market not doing well. If we look at IGV for the software sector, that had a nice little bounce, but again, trading on the heavy side. What about the semiconductors? Doing okay, definitely outperforming the general market, but still trading a little bit on the heavy side. What about the Mag 7s? They're, really reflecting the broader market and trading sort of very, very heavily as well. So, and what about the equal weight on the Russell, also trading badly? So everywhere you look, there's quite a lot of pain, except for a few sort of specific winners. Some of the defense stocks, sort of AI generating, sort of drone stocks are doing quite well, defense stocks. But overall, the equity market trading very heavily. What would the equity market need? Obviously, it would need the Strait of Hormuz to open, especially it needs the oil price to go down. It needs perceived pressure on upward inflation to come down. And it probably needs a little bit more stability in terms of policy making from the administration as well. There's a lot of uncertainty. We seem to get different tweets every half hour. And none of this is good. So that's what the equity market needs to see. Now, if the equity market were to receive that news, there's no reason why we can't have a pretty aggressive bounce. Okay. Just looking at global equity, we continue to see that we've got SPY divided by EFA, so Europe and the far east of Asia, essentially the developed markets. You can see that the US was underperforming, then outperforming at the beginning of the crisis, and now just sort of muddling along. But where we are seeing some pain is definitely over in Europe. Obviously, Europe much more exposed to high energy prices and geographical proximity to the problems in Iran and Israel and the US. And you can see here that the Euro Stoxx 600, very, very weak. It bounced off the 200-day, but it looks as though it wants to retest the 200 moving average. In Germany, very, very weak price action as well. In Japan, Japan is not doing too badly. In Asia, the Kospi is doing okay. There was some governance rules changed. So the Kospi over in South Korea are actually doing quite well because the government actually, I won't go into the details, but changed some of the governance in terms of the stock market there, which was considered a positive. And to be honest, like the semiconductors and memory chips are still in great demand. We saw Nvidia talking about, $1 trillion worth of orders for 2026, 2027. So, there are certain parts of the market still doing pretty well, as I say, and probably, the memory chips makers and the chip makers and the memory card makers all doing pretty well. So the cost is still doing okay, but overall globally, like you look at over in India, doing very badly, very exposed to energy. You look at China is doing okay, but still trading on the heavy side. If you look at in Australia, also trading very badly as well, and that initial sort of risk premium because of energy and commodities has faded. There's also concerns that Australia has a very, very small amount of energy reserves, much less than most G7 countries. It's an importer of especially refined products. Not so much the crude, but especially refined products, and it has a just-in-time sort of delivery system. So there's even talk that Australia may have to start rationing within a few weeks, and then they may even sort of start to run out of sort of refined products because all of their refined products come through Asia and essentially from via the Hormuz Strait. So they're being very, very affected for the refined products. So could start to get quite a lot of pressure on the Australian markets coming soon, just because of shortages of refined products. Moving on, now we have the ECB this morning. Sorry, guys. We have the ECB this morning. They are not expected. So they are not expected to do anything, but let's keep in mind that they have one mandate only, which is inflation. So it's not full employment. In theory, I mean, obviously there are political pressures regarding unemployment and whatnot, but the reality is that their single mandate is for inflation. So inflation is going up. But what we can see here is that let's say, for example, the 2 year, so the Schatz in Germany has massively repriced. And if we actually go and have a look at the Ster markets, so the short-term interest rates, and look at the Euribors, let's say, for example, we look at which is equivalent to the SOFR or similar. You can see here we've had a massive repricing. Just looking, for example, at the December contract here, so you can see that over the last 2 to 3 weeks, this has come in 67 basis points. So this is hawkish. Excuse me, repricing. So the point is, what's interesting today about the ECB this morning is that they probably won't hike. And although Lagarde might say that, they're looking at energy prices, they have, there are upside risks to inflation, but they're still seeking more data. The point is here is that it's going to be hard for Lagarde in a certain sense to out-hawk, to be more hawkish than the market, because as we can see here, depending on the contract, European short-term interest rates have essentially repriced in a hawkish manner, about 50, 60, 67 basis points over the last 2 or 3 weeks. So they've essentially priced in 2 hikes. And then, so going back then to the, let's say, for example, the 2 year, you can see how much the Schatz has come down. We can also see, for example, the 5 year, the Bobble has come down a lot. We can see that the Bund, the 10 years come down a lot. We can also see that the 30-year Buchsel's come down a lot. So the point is that, how much of this is priced in. And if we actually have a look over at the euro, you can see here that the euro has actually fallen against the US dollar. So what's interesting is that we're no longer, the differentials in terms of the yields are no longer sort of benefiting the euro. And really this is pricing, is being priced on the oil price and energy and nat gas. So the point is that the euro, even though the yields are ripping higher and inflation is ripping higher, this is being perceived as a negative for the euro because of the energy prices and the potential hit to growth in the eurozone. So the thing is that, normally one looks at the differentials between the US and the real yield differentials between, let's say, the US and Europe, but that relationship is broken down because as I said, despite the higher yields over in Europe, the euro is not benefiting. It's actually opposite. So my point being here is that there could even be a dovish surprise in terms of from the market reaction, because if Lagarde is a bit more circumspect and says, well, it could be temporary, we have to see what's going on. We're not sure that we need to hike aggressively just because oil went up in the last couple of weeks. Maybe the market's going to take that in terms of the bond market sort of dovishly, because as I say, a lot's already priced in, and who knows, we may even get a little bit of a rebound in the euro. On the other hand, of course, Lagarde might be, sort of very, very hawkish and say that there are definite problems with inflation. She's very concerned about, the price of energy. So that's what's going on there. If we look at actually the US, we can see yesterday a very big sell-off. So you see here during the press conference, you can see the 2-year here sold off aggressively, continues to sell off. So the front end really ripping higher in terms of the yields and obviously the price going down. All across the board, though, you see that here's the 5-year coming down yesterday, continues to bleed this morning. You can see the 10-year also coming down and the 30-year, but you can see at the back end of the curve, not quite as much. So really what we're getting here is a very aggressive push up in the front end of the curve. So those yields pushing up. So we're getting a flattening. So some kind of sort of bearish flattening here. And if we actually look at the yield curves, let's look at, let's say it's the twos 30s. I'm assuming that's going to have flattened. Yeah, it's sort of flattening here. So really all of the yields are going up, but especially at the front end, just as the market essentially prices out, prices out the sort of cuts. And if we just, again, rather than looking at the Euribor, let's look at the implied yields here on the SOFRs. And you can see here, let's say for December, that had been rising. So just think about this. Basically, at the beginning of the war, we had the implied yield at about 3% for December. It's now at 3.60%, so 60 basis points. Getting similar towards Europe here. And again, a lot of that even yesterday, we went up from 344 up to 360 essentially. So about 10 to 15 basis points of cuts taken out at the front end for December, just as an example here. So really the market's getting to the point. And keep in mind now that the effective Fed funds rate is 3.64, I believe, this morning, 3.64, 3.65. So we're at a point now where the market has essentially taken out cuts for this year. And so this is going to be very interesting for Walsh coming in, but we'll talk about that later on during the year. Okay, so getting back to some other markets here. If we look at energy. Okay, so oil, big things happening here. We saw that the one of the largest Iranian nat gas fields was attacked by the Israelis yesterday. Now they shared that field with Qatar, and so Iran, in as retaliation for that attack by the Israelis and the Americans, essentially attacked the Qatari portion of that large sort of nat gas field. And so this is one of the largest nat gas fields in the world. So we now have direct attacks on energy production infrastructure. Specifically, the nat gas market is not doing well at all. And what we're seeing here is that we're also seeing a huge divergence. So we saw oil spiking up yesterday, but when we say oil, we have to be very careful. This is the WTI, so West Texas Intermediate, the American benchmark. So you can see here that's now trading at about about $96 or so. So it's remaining elevated. But if we look at Brent, you can see that Brent is at 114. You see the different prices here. So you see Brent ripping much higher, almost to highs. Now compare that to WTI. So the point is here, we're getting a huge differential. The spread between Brent and Dubai and Murban grades, so the Middle Eastern grades and the European grades, is much, much higher and much more aggressive. And there's also talk here that maybe in the US, Trump will start putting sort of export bans on US oil or US refined products to try and keep the price of oil back home in the US a lot lower. So let's keep in mind that when we're talking about oil, a lot of the pain is being felt in Middle East grades. Urals with the Russian grade is going up. Brent is going up. Now, the WTI, as I say, is staying elevated, but not nearly as crazy as over in Europe. And you can see this, for example, over in the TTF, which is the nat gas benchmark for Europe. You can see that that's spiked higher massively on the news that Qatari and Iranian nat gas field had been damaged extensively. And now we're getting to the point that not only is the Strait of Hormuz essentially closed, except for a few ships who are being allowed through, we're also getting almost no nat gas coming out of there, and that's starting to cause problems, as I said, in countries like Australia, Korea, East Asia, all of these kind of countries and these sort of Asian economies. India not getting enough energy, and in Europe. And this is the whole point we have to watch out for in Europe, because we see the Brent price going up, we see the Middle Eastern grades of crude oil going up, but we're also seeing jet fuel going up, and we're seeing things like nat gas here. You see the nat gas contract just exploding just sort of overnight here, going up, whatever, 29, 30%. This is very, very inflationary. And also it could be causing a sort of a growth hit. And that's one of the reasons that despite the higher yields in Europe, we're also seeing the euro, the currency, actually under a lot of pressure and weakening. So this is all sort of the input into all of that. If we have a quick look here at just some of the FX, we can see that the dollar gained substantially yesterday on the back of the perceived hawkishness from Powell. And basically the fact that inflation is still sticky, energy prices are sticky, and essentially FX now, they're really trading on oil prices and energy prices globally. And we can see that the dollar index is starting to push up again to that very, very key level where it's finding it difficult to break out, about 100.5 or so, but basically pushing higher. We see the euro, as I said, under pressure below the 200-day moving average, fell yesterday, up a little bit today. And again, as I said, a lot of the hawkishness potentially is priced in. But again, we're going to have to see the cost of European energy go down and maybe the yields to be going down to give any kind of support there in the medium term. But in the short term, let's see what Lagarde has to say. Overnight, we also had the Swiss National Bank. Now we see here that the dollar has strengthened significantly against the Swiss franc. And basically, the Swiss National Bank, they didn't do anything. They didn't cut or they didn't hike, but they said that the possibility of going negative had been raised a little bit, was more possible. They were very unhappy about the strong Swiss franc because Switzerland imports 20 to 30% of their goods. So that's causing deflationary pressures. As well, and they're very unhappy with that deflationary impulse. So they're trying to sort of get the inflationary impulse up a little bit more. Inflationary impulse they want up a little bit more. And essentially, the Swiss National Bank Schlegel, the governor, said that the possibility of intervention in the FX, which essentially means selling the Swiss franc, is definitely a possibility, even a probability. And so the market not really liking that. So apart from everything which going on with the US yields and the Fed and the cost of energy, the potential for sort of negative interest rates in Switzerland and intervention to sell the Swiss franc is putting downward pressure on the Swiss franc. So that's why you're seeing here USD, CHF go up. But the reality is that the Swiss franc will always be in demand. So any signs of sort of dollar weakness, I think we can see the Swiss franc rebounding pretty swiftly. In terms of Japan, sorry guys, I've got a very sore throat. In terms of Japan, we had the Bank of Japan meeting overnight. They didn't do anything. Basically, Ueda, the governor, said that if the economy continues to evolve as expected, there could be the possibility of hiking. Essentially, what this means, as expected, means higher wages, and we're getting the Shunto, the spring wage negotiations. They're happening at the moment. And I was just reading yesterday that a lot of the big companies are offering quite large wage increases. So there could be inflationary pressures coming from wage increases, which will put upward pressure on core inflation. And basically, Ueda, governor of the Bank of Japan, was saying that if that continues to develop along that path, a wage hike could be in the cards. So market participants are now looking maybe more for a hike in May. Now, having said all that, could we be in intervention territory here? Because we see that USD JPY is around about 160, and that's where the market starts to get a bit nervous about sort of intervention. You can see here, this is a very critical level here. We could go as high, we have been as high as 162 sort of in recent history. But as you can see here, we're at very elevated levels. So difficult to chase along here. But on the other hand, the reasons for shorting are not yet in place. So keeping an eye on that. Apart from that, just want to go look at the metals to finish off. Gold under a lot of pressure here. You can see it's at a critical level. It sold off yesterday. It's actually been selling off for a few days, but had a big hit yesterday, a big hit overnight. We're now at the 100-day EMA. So critical level here, also at a horizontal support, as you can see, about 4,690. And as I say, that's just because real yields are going up. Our US dollar is strengthening. And as I say, I think, obviously central banks will still be holding and whatnot. Although who knows, maybe a little bit of liquidation to raise liquidity here and there, margin calls, who knows. But basically, a lot of the macro tourists are out of this trade. This is an interesting level to dabble in maybe a long. I mean, but you could have a very sort of tight stop loss here because this is definitely, a fairly attractive level. If you look at sort of the Fibonacci's here, you can see that we are below the 61%. So it's been a very big retracement here. Now, could it go lower? It's possible. It's going to trade on oil prices, expectations for inflations, and the US dollar. It's very simple. if we see the situation in the Middle East sort of calming down a little bit, gold and the US dollar going down and yields going down, nominal yields going down, gold, I think, will have a substantial rally. Is it risky at the moment? Yes, it is, because as we speak, the potential for more attacks on energy infrastructure remains very, very possible. There's even quite a lot of talk that the Americans are preparing ground forces to maybe physically control that choke point just around the most critical part of the Strait of Hormuz. So the situation is hasn't calmed down in Iran. If we look at silver, even worse than gold, you can see here falling below sort of some critical levels here, below the 100 EMA, also below this sort of horizontal support. And the issue here is that for silver as well, silver is a little bit more affected by sort of potential scares to growth. Because remember, part of the story for silver is that it's used in solar panels, AI, electric vehicles. There's a lot of industrial applications up to 50% of its potential end use. So the point here is that if the global economy is maybe are going to suffer some kind of sort of a shock to growth, that's not great news for the general economy and silver either. So silver under a little bit more pressure here. Also, it's a much smaller market than gold. So the fact that the positioning has been flushed out, it does look as though it wants to test down to this level at about 64.60, which would coincide approximately with the 200-day moving averages. Now, copper is also reflecting that story here. You see copper being pretty brutally sort of bashed here below the Fibonacci levels here at the 200-day EMA. Big sell-off yesterday. Similar kind of, this is an interesting level here, so there could be some support here at around about 5.4. We have the 200-day EMA. Again, a very strong US dollar. Some deep concerns about global growth. None of that stuff is good for copper. Just finally, just while I'm in this little category over here, BTC, disappointing price action. I've been saying that the bulls had to breach this level here around about 73.5, 74,000, which they failed before. They failed a second time and decisively failed over the last 2 or 3 days. It doesn't mean this is over, but the bulls haven't done what they needed to do. And you can see here that the 20-day moving average hasn't even crossed over the 50 yet. And if just looking at this most recent impulse on the fib, it's proved insurmountable, a barrier for the bulls to get above the 38% fib retracement, which comes in at about 74, let's call it almost at about 75,000. So weak price action here. This is not great for BTC. What needs to happen here? I mean, it's pretty simple. The longer it stays below the weaker the price action, people start sort of giving up again, and we might see another leg lower. On the other hand, if it breaches that, potentially we'll see more of a push upwards, but a disappointing price action. Okay, guys, I'm going to leave it there. Obviously, today we need to see any headlines coming out of Iran, specifically oil infrastructure. Is any oil and nat gas energy infrastructure being damaged? The Iranians have threatened to escalate their attacks on more energy infrastructure. Any news about that is going to be positive for the US dollar, positive for oil, but especially Brent oil, if you can trade that. But WTI will drag along. It's going to be positive for nat gas prices, negative for risk, negative for equities, especially European equities, and negative for gold. As simple as that. Everything's trading with a very high correlation to energy prices at the moment. I do believe also Thursday we have initial jobless claims for the US, so we get another read on the employment situation. And of course, we have the ECB coming up. As I speak now, it's 7:14, so the ECB coming up in an hour or so. So again, the market is not expecting a hike or a cut. Of course, it's going to be very interesting, really, the forward guidance of Madame Lagarde in her press conference, which I believe, from memory, I'll check, is 8:45 Eastern time. Okay, guys, take care. Have a great trading day, and I'll be back tomorrow with the macro snapshot. Take care. Thank you.